Welcome to TradeMDI.com. This is Jones report is for the 28th. Well, we saw a little bit of the softening take place here on the daily as we recognized the falling magenta was going to have some weak impact as well as the rising short level. You can see now that we do have NBI white clearing over the magenta. Magenta is still though above 25. Can still hold up, but I would still expect some weakness potential from that, and particularly as we approach anywhere near the 38% level. Similar readings on the NASDAQ, so we could be beginning, actually even have a DOC spread here with the sign or shorts moving above midterm buyers and also drop off short-term buyers in steel. So combination of effect. We could see a little bit of softening here going into the last couple of days, but I would imagine they're going to really try to push as hard as they can to show a positive end of month setup, but can't always count on that as a guarantee from them, given what we're seeing from the readings. It's just a tough slog. Again, they're still trying to press the euro because they really need to get it back up over that 107 range. Just to provide some cushion and stability, because it still becomes danger level, but nothing has changed in the EU to suggest that there's any improvement taking place. From a gold standpoint, again, I think it's still opportunity to look for the early entries on these dips in gold, and as soon as we get this full turnaround, in this particular case we've already got magenta above, but don't quite have orange dip on DOC, but move back over the 23%. I think that would be the real strong turnaround play. And oil, again, back over the 110 marker, and it's not going to change anytime soon. The Ukraine situation continues to deteriorate. They keep trying to think of new sanctions, but all they're doing is bifurcating world economies, and that's going to create all sorts of supply issues, which we've already gone over, and they're only going to get worse as we come into the harvest season. Treasuries, of course, the rates are going to continue to climb. There's this mad push to suggest this rapid deflation and the Fed beginning quantitative easing from the quantitative tightening. That's a bit too optimistic, because none of the inflationary pressures on food, fuel are going to change anytime soon. And whether or not you have inventories that have to be liquidated or not, that's not going to be a substantial change in the overall economic direction. So I would look for treasury yields to continue to rise, even if it's just a bit more modest than we had seen prior to that. Nonetheless, the trajectory is still the same. And again, Bitcoin still pushing towards that 20K, and again, fighting it every single time. And this is sort of just the same reflection in the market. It's much more difficult to sustain rallies because money's not cheap anymore. Well, it's cheap, but it's not free like it had been. From an ETH standpoint, again, similar situation, greatly reduced ranges, which is helpful. We get some nice, again, moves from ETH. I think it's just so clean the way it trades with the paint bars and that, but really an effective partner within the overall scope, depending on where you are as far as crypto space and that. And from a 50K standpoint, we can see that we're just flatlining along at 76%. So break below here under weakness would certainly be an indication short, particularly if we're below that 25 on the NBI magenta readings. And we can already see weight spiking there. So there's the potential that this could start to fade off. From an intraday standpoint, we ended up with some decent sells that gave nice range back and forth. And I think we're going to see a lot more of this. This is much more of a traditional market. I think it's just a lot healthier because the S&P's always been a mean reversion market, and we've seen a lot of these situations where we've been hyper trending, and most of that have been easy Fed money, and then those just selling, pulling the plug, and then rinsing and repeating. Now we're getting a bit more of what we would call active trading, which I think is going to be overall healthier for the market, but it's not going to cause the overall numbers to move very much. So it'll be an interesting for people who've been just used to buying something and waiting for it to just go up. I think there's going to be just a lot more sideways. And So active trading is probably going to turn out to be more effective than buy and hold concepts. As always, though, trade well. We'll talk to you later.